Our second speaker, again, a local speaker, Tom Clark, on covered calls. And there's really no better strategy, I think, to talk about it and make sure people can get, because Tom will explain to the extent he chooses what, how this can work, I think, in a fairly straightforward manner for everybody. It's a winning strategy. It can be a winning strategy for you. So let me hand it over to Tom. Tom, do you want to see if you can share your screen? Let me make sure. Okay. I think I have to do something here.
Yeah.
Okay. Okay, now you should be able to. Sorry about that.
Okay, let's see if this works.
Yeah, you see it. We see Zoom, a tiled version. If you want your main screen that shows all of them, or if you want to, works fine.
Well, do you see my screen now?
Yeah, we see the whole screen, including
Okay, let me get
the ship.
All right, very good. All right, good. Thank you, Don. And actually, I think Rick's presentation is a pretty good segue into what I plan on talking about.
Oh, good.
This is going to be more of a show and tell type. I don't have a PowerPoint presentation. I don't get along good with PowerPoint, but I'm going to try to do a show and tell. But before I get started, I'm giving extra credit for the first person who can identify where this picture was taken. It is in North Carolina. Okay, with that, a covered call is basically, I'm going to go through this is very basic. I'm going to get it out there so everybody's on the same page, is buying a stock or having a stock that you own and then selling calls above that price for extra income to add to the movement of the stock. It's as simple as that. What stock to use as underlying? Any stock that you hold in your portfolio that you hold for a period of time is a perfect candidate because it already meets the #1 criteria for a covered call is the stock that you want to own. And you have a good bullish feeling about it. Let me pull up Thinkorswim here. And just as an example, I just pulled this chart up for DraftKings. And if I go to the Analyze tab, you can see a covered call that I simulated earlier today. And there's two ways of doing this. One, you can do it as a covered call where you buy the stock and sell the option, or you can trade them individually. And I show this because if you already own the stock, you can just sell the call. Or if you had a covered call on and the short call expired, you can just add a new short call. So there's two ways to set this trade up. Basically, and I'm going to get very beginnish here, so we don't leave anybody behind and we're all on the same page. But where the cursor stands is where the strike of the short call is. The stock value is down here. So between now and expiration, which is for this particular case about a month out, as the stock moves up, this green line is your target, you will make this amount of money up to the point of the strike of the short call. From that on out, your profit is limited to that level. But it seems like you're giving up a little bit here, but you're not really, because let's say you're right in here. Your profit level now is
Did we lose him?
No, it's my fault. Sorry, Tom. I hit the wrong button.
All right. Where were we when I
Well,
disappeared?
you explain, and it's very, very good for you to go over this for the beginners. So
Okay.
please continue.
All right. I hope I can fill in the gap here. The reason this is better than just holding a stock, because you do give up all this extra gain up here, is because say you're right here and you decide to sell or whatever, you will make not only the gain of the stock, but the decay of the option. So there's added value to the long stock position. You look at my notes here. Use a stock that you either own or that you would want to own. And a neat thing about covered calls, and I will get back to this again in the future, but a cover call, let's say there's 5 conditions or 5 outcomes for a long stock position. You'll either lose big, you lose a little bit, you break even, you might make a little bit, or if you're right, the market goes gangbusters, you'll win a lot. Well, in 4 of those conditions, you will make more if you do a covered call. The one with covered call hurts you is if the stock just blasts through, up here to above the strike price, because you are limited there. But in all other market conditions, and I'll demonstrate this a little bit later, a covered call will outperform the underlying stock. And that's kind of lost on people. Let me look at my notes here again. Okay, I'm going to, like Rick, I do a spreadsheet. And this is a spreadsheet I use to manage my covered call portfolio. Currently, I have covered calls on 12 underlyings. But in addition to what I'm showing here, I started doing covered calls back in the early 2000s. I retired in 1999 and started trading. And covered calls was one of the first things I learned and did. And I've continued all along. My main position out of all the portfolios that I have, my largest position is SPY, and I write covered calls on that. And I have been doing that for 15 years. And it's a major part of my portfolio. I figure it's pretty safe to doing that. But for the other portfolio of covered calls, I use a spreadsheet to kind of help me track things. And I have a tab for each stock that I'm doing covered calls on. Okay, and let me spread this out just a little bit more. The yellow ones are ones that I've closed. But let's walk through. We'll just use this AT&T. Let me talk a little bit about the dashboard first. Here's the 12 stocks that I have covered calls on, the price, the change, the percent. This is straight out of the RTD formula that Rick was using. But each stock has its own tab. And this is a history of the transactions. I opened this position, let me slide over here, the 4th of April, 2020. And I bought 100 shares of AT&T, priced at $28.85. There's a total amount. And I immediately sold an option at 32, which is a little over 3 points above the purchase price of the stock. And I just sit on it. In the meantime, I collected a nice dividend of 52 cents. Expiration day came along. I actually rolled this, paid a penny to buy it back, and then went out to May and sold another one for 50 cents. Okay. And I just repeat this over and over and over and over again. And in May, I decided, well, 100 shares is not enough. I'm going to increase the amount of shares I've got. Instead of going out and buying the stocks, I just sold some puts that were in the money. And when they expired, I was put the shares at a discount of the premium I received for the puts. Okay. From then on, I'm doing 3 lots on the calls that I'm selling these things, collecting dividends as I go along. And here's the latest trade made the 22nd for 19 March expiration. I got 17 cents for these. Now, this doesn't seem like a lot of money, but let's back up here. And I keep a running total right here of these trades. So like this is this plus this equals this. And I just do it all the way down. This becomes a column of cost basis. Like all the way down to the bottom, I have $7,958 in this trade. That's after all the purchases and the discounts I've got from the premiums. All right. Up here in this corner, I have a little, and I'm using the RTD formula again. I've got T and the option, 303, and I pull up quotes in. And so the current value of the position, the 300 shares of AT&T and the 3 short calls, the total value of that right now, or to close today, was $8,557. My cost is $7,000. So I've got a $598 profit on this 6.8%. I annualize just see how it goes at 7.8%. Now, that's not a biggie, but this is a no-brainer trade. I mean, it's very low risk, something you can do over and over and over and over again. That is substandard return from the process. But I have to admit, I'm kind of partial to AT&T because that's who I retired from, and they give me a check every month. Let me move on to another example. Let's check SYY, which is the next one on my tabs. Here I bought, slide this over again, 100 shares for $49.60. Wait a minute, I missed, no, I'm okay. $49.63, sold the May call for $470. That was back in April of last year. I've just played this over and over and over again. And I currently have an 85 call against the same 100 shares. Meanwhile, my cost basis has dropped all the way to $4,200 because of all the premiums I've made since the beginning. And the value of the current holding is $7,932. My cost basis is $42. So I've made $3,658 on this position, which is a 73% return. Annualizes out to 83%. I can live with that. Again, this is I think a low risk strategy. When you can get that kind of returns with a low risk strategy, why not? Of course, a lot depends on the selection of the underlying. Let's step through one more. Procter & Gamble. I'll do this a little quicker. Whoops. I got a new mouse that's got a wheel on it. And it just kind of does weird things all on its own sometimes. Let me get back to the beginning. Okay. April 15th, 2020. And the reason a lot of these start back in April 2020 is this is when I started doing a campaign with a basket of stocks and started tracking it this way. So that's why it looks like everything's starting at that point. I've certainly been doing this type of trades prior to that. But I bought 100 shares of Procter & Gamble, 121.59. Then I started the call campaign, collecting dividends as I go along. All the transaction values are here, and I keep a running total of my cost. At this point, I believe a 55. Yeah, I had a 50. I sold a, I don't remember exactly what happened here, but sold to close 100 Procter and Gamble. Oh, that's right. I got out of Procter Gamble and decided, well, I'll go another one again. So I just sold a put, and then a short put is the same thing as a long stock short call. So I sold it for $3. It expired worthless, so I kept the 3. But in the meantime, the price of the underlying exceeded the 144, or was less than the 144, excuse me. So I ended up being put the shares at 100, shares at 144. And I just repeat, continuing on along. Did I do another call? I did not do another put. Still collecting dividends. In the end, after all this, my cost basis is 11,000. The current portfolio is worth 12,000, so I've made, $1,100 or $1,010. Like I say, I've got 12 of these positions. Now to keep track of all this, and by the way, I don't know how many of you belong to Airmere and listening on Tim Pearson's Thursday night group, but I patterned this after a spreadsheet he showed. And instead of using his, I just kind of did my own so I'd understand it. But my first tab, I call the dashboard. I think I got that from Tim. I have the 12 stocks I own, and I'm pulling the values out of all of these other tabs. And as far as the current price, the options that I have against the stock, the price, current P&L, annualized out, cost basis, current value. So I can look at this page right here and see if, how I'm doing. And this is how I monitor the whole portfolio. I will go maybe once a week, certainly a few days before expiration, and I will look at this and I says, that's a 31 call. T is at 28.63. I don't have no worries. It's going to expire worthless. 85 call. Price is 80. Again, it's going to expire worthless. Let's see if I can find one here that's, here's one. I think that's Viacom. That's a put. 60, 16. There we go. Haynes Brands. That's a put too. Wait a minute. I don't see one that's in trouble right now. But I can just go through the list and see which calls are looking like they might be in jeopardy. Okay, let me go back to Thinkorswim for just a minute. And I want to show you how I select which put to look at. And I'm going to stick with the stock here. I'm going to go to the trade tab. I'm going to go, I pick an expiration between 3 and 6 or 7 weeks. You could do this by using just the monthlies and cycle every monthly, but I kind of like to stagger the expirations so I don't have all 12 of these things expiring on the same day. I go down one of the tabs I have set is probability of in the money. I scroll down that and I look for the first strike that is below 15%. And typically that's the call I will sell. And let's see here, I can probably get, $1.18 or so, $1.17. The lower the percentage of being in the money, the higher the probability to expire worthless. Okay. And 15%, I think it's probably like 2 standard deviations, something like that. So, 9 times out of 10, almost, this call will expire worthless. And you get to keep the premium. So that's basically where I select my short. Let me look at my notes. I think that's all I was going to do on covered calls. Don, do I have any questions?
I've got one.
Okay, go ahead.
Yeah, Tom, appreciate it. When a stock goes against you with this kind of trade, let's say drops like 15% or something, your covered call, you buy it back because that first covered call that you just sold is now worthless, right?
Yes.
You're selling that next covered call. The stock might be down so much that that covered call you're selling, were the stock to rally, locks in a small loss for you. Like right? Like if you're doing your 15% or so. It does,
Well,
that
first
come
off, it
into
has
an-
to rally 2 standard deviations. No, okay, let's say that I'm approaching expiration and when I'm in the money, is that what you're saying?
No, sorry. Without a picture, it's kind of hard to explain. I guess I'm saying
Stock dropped.
yeah, stock drop.
Okay. If the
That
stock
first
drops,
call,
the short call will expire, will lose value more
yeah,
quickly than if
super
you
quick.
just sit on it.
Exactly. So you're getting rid of it, right? You sell it for $1, buy it back for 5 cents. You're out of that.
Exactly.
You're in like 3 days, right?
Could be.
So
What do I do
what are
then?
you doing?
Then I do the exact same thing. I look for the 15%. I may go out another period, a couple more weeks, depending on time's left. I stick with the 15%. I wrote it down. I'll write it back up. The premise being is I still like the stock. If I didn't have the options on it, I'd still own it. Okay. So if the stock drops, the option, and say I'm mid-cycle and the option becomes worth a nickel and I still got 3 weeks left, why not sell it? Why not buy that back, sell another one at a lower strike, still at 15%, and just, write it down if you have to, because the stock you selected is a stock you want to own and you want to keep, and you are still bullish about it.
And you're just saying don't get worried about being called away if you're picking these 20 deltas, this 15% probability of expiring in the money.
Okay, that's a good point. I didn't talk about that scenario. Say either this happened or the initial purchase of the covered call and the stock rallies and breaks through your strike. You've got a couple things you can do. One is you can roll the strike out and up, go further out in time, go up a strike or two, and still might get a credit if you go far enough out. I don't particularly like doing that. What I'll do is I will buy back the call even though it's in the money. And if I sold it for 50 cents and I've got to buy it back for $2, that in a sense on paper is $1.50 loss, but it's not because the stock rallied $1.50. So I don't hesitate. And again, it's a stock I'm bullish on. I want to keep it. So I will buy back and then the money call and write another one, even if it's at a loss.
Okay.
Does that answer your question?
Yeah, add some perspective. Thank you.
Yeah, and you're campaigning this thing. And over a year and a half, 2 years on a particular issue, there's going to be months where you get kind of caught between like that. So but yeah, I either roll up and out or I just buy it back and sell another one like I regularly would. And over time, that'll work out. Let me see if I can pull that dashboard up again. Let me look at Viacom. I mean, I got $10,000 profit in that. Now, let's look that's 400 shares at $23. Right now, it's a 62.50. Where did that profit come from? It came from the growth of the stock. Okay. And yeah, that's kind of the thing I look at it. You either make it in the stock or you make it with the calls. Do I have another one I want to show? probably not. But you can see some, oh, I know one other thing. When I started this process, and this is something I learned on Airmere, is when you campaign strategy, you got to put a fixed amount of dollars aside for that strategy. It's called planned capital. And that's the pot that you pull money in and out of as you campaign the trade. So you need to, and I started this back almost a year ago. And I says $100,000 is what I'm going to devote to this strategy. But how do you keep track of that? Well, over here to the side, I keep track of every purchase. Like when I bought the telephone, I paid $2,800. My 100,000 went to 97 change. I did that for every time I bought a stock. I deducted its price from the available capital. I think they call it planned capital is what term a lot of people use. When I ended up getting called or sold for some reason, it would come, I would put that back in here as a positive number, increasing the cash available to continue, more or less. And I did this all the way through. And when I have a put, like I have in Verizon right now, I didn't really buy anything, but I've got to set aside $5,700 because I could get called. So I put that in here and I subtract that out. So I know out of that original 100,000, I've got 37,000 left that I can continue trading. The profits when I exit a particular trade or a particular symbol gets put back in here in this pot of money. So this pot of money hopefully grows as I take money out, put money in, and there's always telling me how much is available if I want to put on a new trade.
Tom, is that approximately the same thing as the value of your account?
I was just fixed to head there. This is how much cash I have in the strategy. Over here, if I total up, these are the individual values of the positions. If I total that up, it's this. Excuse me, it's this. Yeah. And well, I don't want to fumble around here too much, but yeah, I do take into money that I profit goes back into the pile, and the current value of my holdings plus the cash I still have left, the total of that minus the original 100,000 is my profit. And right now I'm at 49,000. So I'm 50% in a year, less than a year, using these 12 stocks plus the 3 or 4 maybe that I have no longer. Yeah, there's 5 there that I went with for a while and got out of. Let's see, I think I've shown pretty much what I want to show on that topic. Any more
Great.
questions?
Can I ask one quick question?
Sure.
Does the, let's see, how would it, does some of that gain correspond to the rise in the value of the stock market?
Absolutely. I'm glad you asked that. Let's just pick one at random. XLE. $261 is what the initial started. And the price was $37. Okay, is where I entered this position. It's now at 49. So that shows $12 of the profit is based on the underlying. Okay.
Right. And how much other profit did you make beside the rise of the
I only track the profit of the strategy as a whole. Does that make sense?
Yeah. So and how much did that?
This one I've got $376. It was not a good example.
And only $12 of that was, or how much of that was how much again did you say was from the rise of the value of the stock?
$12. So actually, this is a case where I probably did something doesn't look right.
So the call writing strategy was immensely profitable then, and the
Yes.
dominant source of income in this case.
Yes, yes, exactly. That's the point. I was, in the very beginning, I said there's 5 market conditions, and you only get hurt when you have a runaway bull. In this case, well, actually, this is the current price. So a lot of the profit in this one is in the stock.
So Tom, what you bought it at 37 there to start it off, and
Right.
what did they get called away for?
Well, let's see.
Isn't that in your sheet?
This is
Yeah, it looks like you sold the 34 calls in
yeah.
late November. And so they got called away for 34, but then you bought some more. And then maybe those with a cost basis of around 35 are the ones showing you a profit up to 49.
Are you looking up here?
Yeah,
Okay, this is just the current position. Okay.
right. So
So
your initial one for 37, if you scroll down a couple lines.
yeah.
Yeah, so you line 20, no, scroll down a couple lines. There you go. So line 24,
Okay, I got assigned at 34.
you got
Yeah.
assigned at 34, but then you bought more
Exactly.
near 40. And then are those still the shares that you're holding on to right now?
Yes.
Oh, no,
yes.
it looks like you had to sell them for 38.
Yeah, they go in and out depending upon how things are assigned. Like take, for example, this one on the line 25. I bought the shares, sold the 38s. Well, then I actually sold a put to get more shares because I got called out.
So it looks like maybe XLE is not a good example.
No,
of
this was not a good one. No.
Got it.
Yeah, this is let me go back to my dashboard. And Viacom was the good one. And if I really wanted to show you how good this worked, we could step through this one because obviously I got $10,000 profit, 60%. But a lot of that was due to this might be a good one. $23 is my initial cost. It's 62 now. So you can see where the profit come from. The increase in the stock. Any more comments?
Does that account for all the profit in that case, or was there also some from the selling of the calls?
Well, that profit is the combination of the movement of the stock and the profit and loss from the calls. I don't break them out separately.
Right.
I treat them as one position.
So are you doing this mainly, like you showed the purchase of the shares at the beginning of each of these trades? Does how would you do this if you already owned a large portfolio or of shares, or do you?
Well, if you could just start this out and establish your cost basis at the current price.
Sure.
And that would be one way of doing it. And, you don't, I kind of go down rabbit holes sometimes. And I probably overcomplicated this a whole lot more because I find out that the more time I spend playing around with this stuff in Excel, the less time I spend watching the market and trading, which is probably beneficial.
Yeah.
So I spend a lot of time in Excel and just
No, you've got those are excellent records, and they give the basic idea that people need to look at all the components of the trade.
As a little aside, when I started putting this together last week, I realized and there's probably some of them in here that are some errors. I went back and started doing an audit on some of them. And and this kind of a segue into I still have time left, don't I, Don?
Absolutely.
Okay. I'll segue into my second portion is over here. I've actually downloaded the actual transactions from my broker. And I'm slowly transitioning from doing this over here instead of manually putting this stuff in. And that should eliminate any errors or omissions. So that's that. I'm kind of halfway betwixt and between, but my next step is to move all this over here, and it'll no more mistakes of me putting the wrong numbers in over here. I'll be getting the data straight from the brokerage. And
yeah, that's great. Dave posted a question in the transcript.
Okay.
Dave, why don't you read it if you would? It's easier than my reading it. Out loud, like I can read it. Dave said, XLE is a good example of what may happen if you get a sharp move up. Covered calls won't be as profitable as just a long. Would you agree with that?
Absolutely. In fact, I said that in the preamble. It's the one out of the 5 market conditions where just owning the stock itself would have been better. Okay. There's no denying that. But if you're campaigning a stock, then you take the good and the, I mean, is it really a bad thing? I don't think so. The times that you collected the premium prior to that event will far outweigh, getting called away and having to reestablish position later on. But yes, if the stock goes and breaks through your strike price, you are assigned and you give up that appreciation that was above the strike, And I think realizing that that's not bad is hard to do. And it really holds a lot of people back from doing covered calls. You're making money. Yeah, you might have made more money somewhere else, but you're making money here and it's probably a safer bet. Does that answer the question?
Covered calls are probably the safer
Yeah.
bet.
You can sleep better.
Maybe, can I ask a couple of questions that are sitting here in the transcript before you
Sure.
go on? Jamie Kinchin says, can you make putting in the actual transaction data from TOS automatic with RTD?
That is the second half of my presentation tonight.
Excellent. And the other question from FS, how do you pick the stocks?
I don't know. I'm not exactly sure. I was hoping to go through this without having to go down that rabbit hole, because I answer it by saying that if you write covered calls on stocks that you want to own and that you feel will go up, it's a good strategy. I'll leave it up to that person to make that decision themselves.
Sure. I mean, if the overall strategy works well, presumably you could go with anybody's list.
Well, and let me mention a couple. Covered Call Advisor just look up Covered Call Advisor
Sure.
.com. I thought I had this. It's a blog, and this guy has been doing covered calls since like 2000, I think. And I started following him about 2002, and he posts all of his trades, and he gives a real good analysis on why he picks the stocks, and why he, every time he either opens a trade, closes a trade, or adjusts a trade, he gives very good explanations, not only on the technical side of it, but on the fundamentals. And I should have that URL with me. I don't, but I will open a spot in the chat room, and I'll post a link to his blog, because the guy's really good.
Or somebody else can look it up right now and post it
Yeah.
if they would, because you're tied up with this.
And I lost my screen. Oh no, I'm not. Okay. But yeah, I follow him a lot, and I also subscribe to Seeking Alpha, which is a I don't know how to describe it. It has a lot of contributors that contribute articles,
Yeah.
and you can kind of put in what type of articles you're interested in. And so I get a daily feed from them with other people's analysis of what's good stocks and what's bad stocks. And I just go through them and see if there's anything I like. But yeah, there's no question that the success of this strategy depends on picking good underlyings. And they
Very
don't have
good.
to.
And we'll stop asking you questions now and let you get on
Okay.
with the other part.
Okay. The second part, and I don't think it'll go, surely it won't go as long. I want to just briefly, and I think somebody asked a question in the prior presentation about how can you import data from Thinkorswim into a spreadsheet.
Right.
And I actually have been doing that for years. I'll demonstrate that. And I'll also demonstrate how I do it with the Fidelity account I have. And I assume you can probably do it with other accounts. Let me go to telephone here. And if you look, yeah, let me just pull to Thinkorswim. Look at my notes here. Okay, if you go to monitor account statement, here's your trades. You can set it for particular time frames. This is going back 7 days. I could go back for the entire year. I can get just today's. I don't see here's just the trades that I've done in the last few days. If you select a trade, it highlights. And if you hold the shift key and go down here, you can select a group of them. Control C, copy. Go to Excel. Whoa. And just paste. Right there it is. Okay, so that's how I import data from TOS. There's a column here that's worthless. Most of my spreadsheets that I import data to, I have this column hidden. Optionally, I didn't know this until later. You can, through the menu over here, you can select which columns to have across here. So you can kind of tailor what gets dumped out. But that's how I get data from Thinkorswim. Let me pull up my Fidelity account real quick. I can do kind of the same thing here. If I go to accounts, history, there's T, I can select. Control C, pull up my spreadsheet again. Paste. And I've got to say, now they use, a different format, but there's the exact same thing as the price. This is a call. There's a symbol, a call option. It was 17 cents. I did 3 of them. That's $49. Does that make sense? Yeah, I guess that's about right. That's how I import data from Fidelity. I would assume that it's a inherent system, this copy and paste from tables. I would just about bet you could do something similar to that with any broker's platform. The one thing I don't like about Fidelity's is I can't grab 3 or 4 at a time. I got to grab them individually. But that's how I get data out of the trading platform into Excel. And I got one other thing I want to share. Why would you want to do all this? Here's another spreadsheet that I kind of keep a record of different strategies that I trade. This particular strategy is a weekly call credit spread that I do against VXX. I've been doing it forever. But what I do is when I put the trade on, that's this line here, I copy that string and put it in here. And then if I adjust it, or if I have to, close it out, I grab that string and put in. So I have a complete record of every transaction for a particular strategy, for a particular position. You can easily sum it up over here. This one expired worthless. So the profit carries right over there. I got $181.08 profit. This is really neat because you can, I don't think I did it in this particular spreadsheet, but like here, I'm using a 4 lot. Up here, I've done a 2 lot. You can add another column out here and put, well, I think I did that in here. This is a 1 lot profit. So you can normalize things to a single lot. With all these numbers, and they go back a long way, you can do all kinds of analysis of, expectations, Sharpe ratio, expected return. You can really track a strategy and know if it's working for you or it's not. And like this one, this is my 27th trade with this particular strategy. And I usually annualize. I think Rick talked about, 5% profit may be much, but if you did it in 5 days, that's pretty good. I usually try to annualize my returns. I don't think I did it in this spreadsheet. But anyway, I've got a tab for everyone. Here's some at the money puts that I do. Parking trade from Tim Pearson on Aramir. This is a strategy that I'm doing right now, which is a 2.5 week broken wing butterfly against RUT. That doesn't make a lot of money, but percent return annualized has been pretty good. And like I say, here's my profits going down here. You don't see, there's a loss. The last one, last week was a loss. I had a loss up here. But let's see if I've got another one over here that might. There's the toss calendars. Who was it? Mosley did the presentation about calendars, probably a year ago. That got me kind of going on that. And I've been doing them against IWM, RUT, ACT. Found out real early that doesn't work with low price stocks. Commissions eat up too much of your profit. But I've got every trade I've done with, this is with multiple symbols, RUT, Q, this one I lost on, VXX I gained, EEM is still open. Okay. Anyway, that's, again, it takes a little bit of time to do this, but that's probably keeps me from over trading. That's it.
Very
any more
good.
questions?
So of those strategies, Tom, how would you rank how you have experienced them? In other words, which ones do you think you're more impressed with? Have I traded them for a while? And which are you less impressed with?
A couple. And in any trade, I find out that it may turn sour on you. And so you quit, and then you come back to it 6 months later and try again. And
Sure.
it may work. But I like the RUT broken wing butterfly that I do the 2.5 week trade. I put it, that's a butterfly that I buy, but I actually get a credit for buying it. So they pay me to buy it, and it expires worthless. I keep the credit they paid me to buy it. And on occasions I can make an adjustment and take in additional credit. So it's just I've
So
had a
that would
lot
be,
of,
yeah, that would be in the weeklies. Would that be analogous to some of Dan Harvey's trades?
actually one of Dan's trades kind of inspired it. Yeah, he did something very similar to this. I forget the service I played around with for a while.
Mhm.
Was it the
Not
box?
Boxcar though.
It may have been, I don't know. I didn't stick with it, but in some of his introductory stuff, he was talking about doing something this was with spies, putting on a butterfly and paying 10 or 15 cents for it. And I really can't demonstrate this, but when the T+0 line rises towards the expiration line, there's what they call the butterfly effect, to where the
Yeah,
T+0 line will actually go above the T+0 line.
yeah.
And that's what you're shooting for. And if it doesn't happen, you can roll the upper puts down a notch and pull an additional credit and raise that T+0 line above zero. So yeah,
So
it's
that's
got a lot
just
of Dan.
a particular nice spot that exists that you can get that, position yourself into it.
Yeah, I do it to where I try to put it on for a credit. And Rut's been real. I can't do it in SPY right now, but Rut has been really killing it here lately. Is I can put on a broken wing butterfly for a credit and be over a standard deviation away from the upper strike.
People are saying that that trade has been working very well in the high volatility. Is that right?
I would imagine that's part of the reason why it's doing so good. And I've had, let me see, do I have that? Right here it is. Actually, this one I lost on. But there I've got, excuse me, $250. And I'm always, my at risk is 3,700. So I'm not going in. This is just something I play with on the side. But out of 3,400, I pulled 258 in what, 17 days? Okay. Made a profit there, profits. Just scroll up to see where I got into trouble. Very small loss there. A couple big losses there. I think I was asleep at the wheel at that time. Now back here, I was experimenting with the whole idea. So I had some losses back in here, but you know, it's and I was doing SPX, and you know, the premium kind of dried up, and yeah, XPX I could get more. The Rut seemed to be a richer premium. And,
That's what a lot of people are saying on Arimer these days, that they switched back after having abandoned Rut for a year or two ago.
yeah, yeah,
they've now come back to it.
Yeah, this is just a simple trade to put on. I look at it once a day, and usually let it expire. On occasions, I get the opportunity to do a little put credit spread in the last few days to pull in a few more pennies, but I'm writing these things so far out of the money that I'm getting a credit to start with. So the opportunity to do additional credit spread as an adjustment later on usually doesn't exist.
Do you think longer term broken wing butterflies are broken now, do not work, are inadvisable?
No, this one's working.
Okay, but how far out is it?
Oh, I'm a standard deviation out.
Yeah, but I mean, in terms of time.
Oh, 2.5 weeks.
Well, exactly. I meant longer, like people used to put them on much longer time periods.
I would think the same. I haven't really tried it, but I would think that if you use the same parameters to set it up, as far as how you position it to the market, it ought to do just as well.
But the safest trade would be the covered calls.
Oh, yeah. Yeah, I mean, they're certainly easier, and it's a strategy that I recommend for beginners. I mean, that's where I started, and you can start getting a feel of things. Of course, we eventually moved beyond that, but then I'll be honest with you, these strategies, the butterflies, the condors, the credit spreads, the calendars, probably represent less than 10% of the value of my entire portfolios. Okay, so this is, I don't put my majority of my capital at risk trading options. Covered calls is kind of betwixt and between, and I feel pretty comfortable using that. The other thing I do, and the largest holding I have, is just simply the SPY ETF, and I sweeten those by writing covered calls, and have been for 15 years writing covered calls on SPY. But the spreads, the butterflies, the calendars represents a very small portion of my total investment assets. I just don't feel like I don't want to handle that kind of risk.
Did you say including the covered calls, or which side of that would they fall?
They're in between.
Sure.
Yeah, I mean they're in my my Thinkorswim account is the one that I do all the spreads, calendars, and stuff like that. My Fidelity accounts where I do my covered calls and my SPYs.
Well, if you can keep risk to a point where it is only a minority of your account, then and of your net worth, then probably one can trade a lot more with a lot more equanimity than taking too much.
You sleep a little better.
Exactly.
Yeah, I have in the last, I'd say 2 years, and I don't know why it took me so long to figure this out, but your success, or anybody's success on trading any sort of option strategies depends on how well you can manage your risk. And I think that's the most important thing. We keep our eye on the bubble. We look at profits and stuff, but think about how much is at risk. If what's that total risk out there, how much you got tied up in that trade, and be ready to pull the plug early.
That's the point that so many people miss. Like whenever we have a talk on risk, it doesn't get very much draw. People compared to talks about strategies in terms of their profit potential.
Mm-hmm.
And it's a mistake people make.
Yeah, I mean, you can put on a credit spread, and if you go far enough, if you use a large enough width between the short and the long, you can get a fairly decent credit, and you do have a floor in the risk. But when you're looking at $100 profit for 5,000 risk, no, because I've seen it happen too often, and one bad trade going sour overnight can wipe out months of my kind of trades, because my kind of trades are, you almost can call them scalping. I go for reasonably small profits, but consistent over trying to score big.
Yeah, and moreover, it's as John Locke pointed out recently, it's to sell those low probability or to take those low probability trades is very tricky because, I'm sorry, high probability trades, because they give you a false psychological feedback that you're God's gift to mankind, or
Oh, yeah.
as a trader. And you just the average person is going to scale up and keep scaling up because he experiences no losses whatsoever. So he thinks that's going to be the case forever until he wipes out his account.
Yeah, and it can happen very quickly. I say keep them small, and that's why I annualize my returns, because I look at some of these trades and I made 4 or 5%. But if I did it in 3 weeks, that's a pretty good annual return.
Excellent. Now I see James Kitchen has another question. So how far out in time do you go to buy your long SPY that you sell weekly calls against?
I actually hold the SPY ETF. I hold the shares.
So he has it in cash. So effectively, or
No, I mean, I go out and buy 100 shares of SPY, and then I
right.
sell a call against it. And I have a large
It's
SPY
equivalent.
holding.
Sure. That answers that question.
Okay.
Let me just see. Does anybody else have any questions? Has anyone else traded, let's see, selling calls and given up because it seemed too much of a challenge? Or has anyone else had a lot of success? Do people commonly sell calls? Should everybody sell calls? Any thoughts? Anybody feel free to turn on your mic and express an opinion.
Hello, this is Dan Queen.
Yeah, Dan.
Hi, thanks for your presentation. I had a kind of a comment or a question on do you let paying tax keep you in a trade, or maybe that's when you roll out and up on your covered call to avoid having this stock exercised.
Okay.
And then that causes you to pay a short-term capital gains. Do you get that conflict in managing the position?
No, that's a good point. I'm trying to think. Yeah, all my covered calls are in an IRA.
Okay, that solves that problem.
Yeah, but you're right to point out that you do create a taxable event if you get called away, which may force you to stay in when you probably shouldn't. So I would, and if you gain a little bit of experience and get comfortable with it, I think covered calls on equities or ETFs is a very conservative strategy that is well suited for an IRA.
Yeah, I agree. The margin account is where I constantly run into the dilemma, and sometimes I lose more than what the tax would have cost me.
Well, I have always been of the opinion that how do I put this? Tax issues shouldn't influence whether you buy or sell a particular strategy. It should stand on its own.
Yeah.
And if I have to pay a little bit at the end of the year, I mean, I used to brag about how much tax I owed at the end of the year, because the more you paid, the more you earned. I mean, that's once you get that in your head, then you just kind of use that as your excuse.
Yeah. Well, one other comment or tip, maybe back on the TOS platform, in your account tab, and you called up a listing of your actual trades there and copied and pasted out of there.
Yes.
Up in the upper right hand corner, at least there is a little 3 lines there,
Right.
4 lines, and you drop down, and then you got the export file.
Yes.
Do you use that, and then you can go and port that out the whole?
To me, it seems like a step in between is required because that dumps everything.
Yeah, but then
I only want a couple pieces of it.
Okay.
So I got used to cutting and pasting but yeah, I'm aware of that you can do the CSV, but I think there's a wasted step in there.
Okay, it just depends on how much data. I usually take the whole lot data and then sort it over there, and then you
Okay, well, see,
trades.
I pull each trade as it occurs.
Okay.
And I have a spreadsheet for each strategy or each underlying. So as soon as I make a trade, as soon as it pops up in there, I copy it and post it over in the Excel. And so I'm kind of doing your sort piecemeal as it goes along, but the same process.
And you don't have to go back to it later. Getting everything there, you go and operate there. And I was using that as my database, where I don't have your database. I would just put it all out and then sort it. Yeah.
I mean, there's
and then do a pivot.
A lot of people do it that way.
Yeah.
And this suited my workflow better. So
again, thanks for sharing your processes.
Okay. Thank you.
Jamie Kinchin had another question. Let me read it. Would you change anything from your standard process if the market were to start coming down? For example, what did you do last year when the market started coming down on your covered calls?
Oh, that's a good question. I was hoping to avoid answering that. There was a lesson learned there last year, and not so much in my covered calls here, but in my main SPY coverage. And the temptation is when a stock goes down and your short call becomes worthless way ahead of expiration. Okay, so you buy it back and write a lower call. And that works real great until the market turns around and it's a long chug back up. So that a strong downturn like that, it took me a while to get it back, because you can never, it's very hard to make up what you lost going down and going back up. But you can.
Good answer.
Yeah,
Any more questions?
It was a difficult period, but it didn't dissuade me from continuing the strategy.
Okay, anything else you'd like to add, Tom?
Well, one final comment. If there's anybody out there who is interested in doing covered calls and has a question or wants some, I don't give advice, but if you need to talk through it, something like that, or have any questions, please feel free to call me. I love talking this stuff with other people, and I have no problems at all discussing it. I'm not going to give my email and phone number out, because I think this will probably end up on YouTube, won't it, Don?
Yeah, although I could edit it out. But.
Well, let me just do this, if you don't mind, Don. If I will go to the Meetup website and start a discussion on covered calls, and I'll put my contact information in there.
Yeah, please, if you think that's advisable. I mean, I can't even.
I mean, I have no problem discussing this with, I just don't want it out on YouTube,
No, I would not.
But for the local members or people who belong to the Meetup, because, I'm a firm believer that if you can explain something to somebody else, it actually increases your understanding of it.
I have found that too, and I really appreciate that, and you're taking the time tonight. And for people who don't know, there is a discussion group on the Meetup website, RDU Traders, and you'll have to hunt a little bit to find it, unfortunately, but you'll find Tom's going to start a thread there, and you can post questions there.
Yeah, and Don, if you don't mind, if anybody contacts you directly because they can't find it, feel free to, as long as they're members of the group, feel free to pass along my contact information.
Okay. Okay. I would never do that without your saying that.
Well,
so
that's why I said it.
I've taken notice of it. Very good. Now let's see. Rick, did you have? Are you still there, Rick?
Yeah. You hear me?
Great. I think, yeah, I can. Thank you.
Let me share my screen, and I'll real quickly share a couple of things that people asked about in the chat room.
Okay, I opened it up.
All righty. Here we go. Okay. You see this? My Facebook page?
Yes, with Carolina.
Yeah. Okay. So that I'm looking at Facebook right now. I like to do things on my PC rather than on my phone or tablet. But so a lot of people may not be aware or familiar with the fact that on Facebook you can also have groups where people that have a common interest can just get together and share things, and it's not blasted all over Facebook. And for instance, just give you an example, this is a group that I operate, had it going for several years, where I post information and links and things that pertain to the history of Durham and Research Triangle Park and North Carolina in general. I've got over 4,500 members in that group. But this is a group that I stumbled across last year on Facebook, and all you have to do is go in on your Facebook and find the little search magnifying glass icon and search for Options Traders, spelled just like you see it there with a space in it. And when it'll pull up a list of various things, and you just click on this, and when you go to one of these groups, you have to click there'll be a button somewhere on there that says join, and you click, answer a couple of questions for the moderators so they know you're a legitimate human being, and then they'll approve and you're in the group. Boom. So you can post things there. And I mentioned that I post on Facebook, so like here's my Facebook page, and I post all kinds of things that I'm interested in on here, which includes every morning, like I said, this little thing I showed you all earlier. And once I get it on here, then I just share it to the Options Traders group. And I also share it to this group, which a lot of you might find interesting also. The name of this group is the Thinkorswim Platform Users. So you just search for that and you'll find it, and join that group. And on here, a lot of times we'll talk about problems we're having with Thinkorswim, or how do you do this, or how do you do that. And in both of these groups are a lot of very seasoned, very experienced traders, and there are a whole lot of newbies just getting started, and they're reaching out for help and assistance. Now the other thing, and also if anybody wants to get in touch with me, just find me, just look up my name, Rick Rasmussen, on Facebook, and private message me or whatever there. All right, let me get that out of the way. Some people in the chat did post some good information about the use of the RTD feature in Excel to link Excel to Thinkorswim. And I just thought I'd show you real quick what that looks like when you do it. On this page I'm showing you right now, I've got this little box here that says RTD, and that's just my reminder that the boxes that I've got shaded that color are using RTD, which is real-time data. So up here, for instance, on 2/24, I bought this option, the 19 March 2021 85 put on TKR. This is the symbol that this particular worksheet is involved with.
And I'm not sure we see the worksheet. Should we be able to see it, or?
Oh yeah, I thought I was sharing all this.
We see Mr. Potato Head.
Oh, excuse me. You were seeing my Facebook page, weren't you?
Yeah, and we still do.
Oh,
Well, have you shared that,
I'm on the
let's see,
same, I'm on the
that
same,
app?
I'm on the same monitor.
I'll disconnect and you can reshare. Here, let me disconnect you for just the screen. Okay, now you reshare, Rick.
All right, boom. Sorry about that. Okay, now you see it?
There we go. Now we see
Okay.
it. Yep.
So for instance, on this particular worksheet, I'm looking at information related to the stock symbol TKR. And in the box right below that, if you click on it and look up here in the formulas, you'll see this equals RTD, blah, 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 and last and B37. And what that's saying is take the symbol that's in B37, which is TKR, and go out through the RTD function to Thinkorswim and bring me back the last price. And so then that price appears here, and whenever it changes here instantaneously. So that's the actual price of the underlying stock. Now up in these boxes, it's doing something similar in that it's taking the formula you now see up here in the formula bar, which is related to this particular option, and it's going out and it's pulling in the mark price. That's the price I like to see because that's the price I'm probably going to try to trade at if I want to close this position. You could do last, you could do bid, you could do ask. I just like to use mark. And so right now, if you went into your TOS platform and looked at the price of this particular option, you should see $6.75. And during the day, as the option prices change, these option prices on this spreadsheet change. And when they do, this column over here, which is net lick, which normally for me, net lick is the same as the price because I've only got one. But when I've got two contracts of the same thing, this is the price that the contract mark is at right now, but the net lick is twice that because it's two contracts. And then all of my net licks I add up right here. I just sum them so that which is basically saying if I closed all these positions right now at the mark price, this is the what I would derive from that. And then I take my original total of debits and credits, and I sum that up here. So that's what I now over all of these various positions over time, I'm now at a net debit of $1.28. But I've got if I liquidated right now, I'd have a credit of $4.13, which would yield me a $2.85 per share profit. So on a position, that would be $284.50. So that anyway, that's how the RTD looks once you put it in a spreadsheet. Well, then you say, well, okay, well, where do I get this formula? Well, you can go into Thinkorswim, pull up an option chain in Thinkorswim on the trade tab. So you can pull up, this and go up here and tell it to export the file, and it'll take all this information and export it to a file, which you can then go open that file up in Thinkorswim, and what you will what you'll see is this. And so if, for instance, if I was trading the this is the underline is looks like the symbol is LX. If I were trading the 110 strike, a call, and I wanted to see the mark price show up in my spreadsheet, I would just click here and say, that's what I want. Okay, there's the formula for that up here. You just copy that, carry it to your spreadsheet, paste it in anywhere. And now what's showing up in this block is the mark price on that 110 strike option for, oh, that's Akamai. That's what that was. I can tell because that's what's in this formula up here. That's how easy it is to get the information to show up in a particular cell in your spreadsheet. You're just coming and you're grabbing one of those formulas off that exported sheet to get you started. Now that I've got some of these in here and I'm familiar with this, I can change this to anything I want, because if you look in this little chunk of data right here, the first few characters are the stock symbol, and then you've got the date. So in this case right here, it's 21 for the year, 03 for the month, and 19 for the date, and then a P for put, and 85 for the strike price. And so looking over here in this block, I know what to type into this block to get that information. So I put these in manually, you know, each time if I close a position, I delete this, and if I open a new position, I copy one of these existing cells, paste it in here, and then go up here to the formula and change it as needed to get the information on this particular position. You can Google it and find out all the details about it. Thinkorswim's got a bunch of good information on it, and I find it very helpful.
Comment?
Yes.
In Thinkorswim, where you go to that one screen you had,
Yeah.
up in the menu item up there, like I discussed earlier, you can select which columns are displayed.
Yeah.
If you pull that up, it'll give you a list of every operand for that formula.
Yeah.
You know, because people wonder, what can I get?
Right.
If you can print out that list.
Yeah. I think they've even got a PDF on their website too that you can download that has all of that. It's in the,
I haven't seen that.
The Thinkorswim manual, I think, has it, or it might be. But anyway, I have a copy of it somewhere on my computer, but I don't need it because it's fairly easy just to, you know, do what like I was showing you just then. Does anybody have any questions about any of that I've just Facebook or this Excel stuff?
We've captured too. We'll capture the transcript that some people have, as you mentioned, Rick, typed in some formulas. So one
thing to keep in mind, I forgot. I mentioned earlier that I started out using Google Sheets. Google Sheets will not do this because it's running on a server up in the cloud somewhere.
Yeah.
You can, a lot of people today are using a free version of Excel that Microsoft has available that is more like they created it to compete with Google Sheets, I think. It's a version of, it looks just like this Excel, except it's running in your browser. And so the Excel you're using is actually running in a server up in the cloud somewhere. And because it's not literally installed on your computer, it can't make that RTD connection to your Thinkorswim installation. So to use the RTD, you literally have to have Excel installed on your computer. Now you can save the Excel spreadsheet in the cloud. I have my spreadsheets saved in the Microsoft Cloud. I can't, what do they call that now? My Drive, or, you know, something like that. And because it's just safe there, and it's not, you know, going to get lost, and I can open it up anywhere, you know, on another computer, or even on my cell phone or my tablet if I want to.
Okay, super. Well, thank you very much again, Rick, for adding those answers to the questions and giving some concrete examples. Hopefully people can get a handle on that, and if not, there are a couple of resources where they can do that.
I just want to say I enjoyed Tom's presentation also.
Hey, Rick.
Yeah.
Do you have a brother named Eric?
Cousin up in High Point, I believe.
Okay.
Yeah.
Married to Jolene?
Yeah.
Okay. I used to hang out with him.
He's in the furniture textile.
Okay.
Industry. Yeah.
I knew both of them. We raced sailboats together.
Oh yeah. Hey, where is that picture that you've got on your computer?
Oh, Oriental.
Oh, yeah.
It's from the town docks at Oriental early
Yeah.
in the morning.
Right.
And a quick story about that.
Beautiful picture.
The Our State magazine that comes out,
Yeah.
don't know if you-
Yeah.
they used to, I don't know if they still do or not, but they used to, in the last page of their article, they used to put a photograph. And that was in there one time. And I says, oh man, that would make a great backdrop. So I scanned it and it just didn't come out worth a crap. So I contacted the photographer and she lives down in Oriental and she was